Hey guys, this is Mark from TRADEPRO Academy, and in this weekend's video, we'll be doing an in-depth forecast of the US dollar 2019 outlook. So let's get at it. Now, before diving into the fundamental and technical outlooks for 2019, let's do a quick review of 2018. So in the last year, investment opportunities have been crowded out by a stronger dollar and an outperforming U.S. equity market. Coming into year-end, the U.S. dollar has accumulated broad gains against most of its major currency peers. In recent months, most of the U.S. dollar strength has been supported by firm growth and rising interest rates, which is in stark contrast to the less robust growth or rising uncertainties elsewhere. The dollar at the moment is one of the few global investment vehicles that offered a positive risk-adjusted return this year. We do not, however, expect this trend to continue into 2019, and rather see the dollar resuming a potential decline that we think began with 2017's significant slide. While the dollar has benefited from rising interest rates and solid U.S. growth dynamics in the last year, we believe a lot of the good news has already been factored into the exchange rate at these current levels, and believe that any negative surprises in terms of monetary policy or growth are liable to weigh on the U.S. dollar sentiment into the new year. So this leads us into the 2019 fundamental outlook. Moving forward, we are expecting a neutral to bearish narrative to develop as 2019 progresses, and there are several reasons for concern over the US dollar. These are the US growth slowdown, a potential change in the Fed stance, current dollar positioning, and political uncertainty. Currency movements can be thought of as a byproduct of global capital flows and of differing levels of confidence that investors have in chasing returns across regions. This is evident as the dollar's performance last year was closely aligned with the extent to which the US economy outgrew others. This year, we've seen the dollar's 9% rally since January reflect on an economy that is expanding faster than most others. However, much of this strength was thanks to the tax cuts that temporarily fueled business and personal spending, a fiscal impulse that is set to decelerate in 2019. Also worrying is the impact of tighter U.S. financial conditions driven by higher bond yields and wider credit spreads. Together, these will restrain business and consumer optimism and remove some of the economic tailwind that the U.S. economy has been enjoying in the last year. The second cause for concern over the US dollar for 2019 is a potential change in the stance of the US Federal Reserve. At the moment, the Fed is foreseeing 2 rate hikes in 2019, which is a much reduced pace compared to 1 per quarter so far in 2018. Since much of the past decade's dollar strength has stemmed from America's relatively higher interest rates, it's fair to assume that a more dovish Fed will have an impact on currency markets. With fading fiscal stimulus and a prospect of inverted yield curve, we're expecting that the U.S. Federal Reserve will be forced to temper interest rate hikes next year. At the moment, the interest rate and FX markets suggest that the Fed will increase rates only once in 2019, which means fewer than expected hikes or no hikes at all will likely put pressure on the US dollar in 2019. In addition to this, rate divergence could be further dented by policy decisions abroad. For now, little attention has been paid to the most important of these other central banks. The ECB has all but promised a rate hike for September of 2019. As markets begin to take the likelihood of this rate hike into account, the dollar may lose some of its sheen. The third potential cause for concern over the US dollar is the current positioning of the DXY futures by speculators. With an impressive run of US dollar strength this year, it's natural that trend-following investors are bullish on the dollar. This extreme optimism, however, creates concern that the greenback's prospects may not be so promising moving into 2019. In terms of the speculative community, the weekly CFTC positioning data reveals a sizable US dollar long at levels last seen in late 2015. The current levels of bullishness are rarely followed by further strength as there are fewer marginal buyers to keep the music playing. This bullish positioning therefore limits the scope for additional US dollar strength from current levels into 2019. The final cause for concern over the US dollar in 2019 is that of political uncertainty in the United States. It's no secret that the tax reform and cuts in 2018 led to a majority of the US dollar strength throughout the year. However, with the Democrats in control of the House, we doubt that they will want to back stimulus plan from which the Republicans could reap the benefits in the 2020 presidential election. In other words, policy gridlock makes it more likely than not that the US growth slows back down to trend at 2%. In addition to this, any policy gridlock in Washington on the debt ceiling could see the US government shutdown risk increase throughout the summer. The political gridlock between President Trump and the Democratic House will highlight the economic instability of the USA and could lead to potential dollar weakness in 2019. Now that we've covered the fundamental outlook for 2019, let's jump to the charts and take a look at the technical outlook for the dollar. All right, Trade Pro. So what you see in front of you now is the 12-month time frame of the US dollar currency index, known on TradingView by symbol DXY. What the 12-month time frame simply stands for is that each candlestick represents a full year's worth of trading. So first things first, what we like to do here is identify the macro trend. We can do this by simply connecting the swing highs and swing lows, and this will give us a general indication of the macro trend. So in this case, you can see we've had a swing low to a swing high, a lower low. We've got a potential lower high being formed at the moment. What you also notice here is that this market has been ranging in 2016's high and low for the last 2 years. So if we indicate this here, it's 103.65. There we are. And the lows come in at 91.92. We can see that this range has held for the last 2 years. This essentially shows that we are showing signs of consolidation at the moment, which has been evident in the dollar over the last 2 years. So let's drop down now to the 6-month time frame. And on this time frame, we can refine our levels a little bit better. What we want to see is the original consolidation range. This will help us identify value to the upside, value to the downside, and the equilibrium of the range. So here we had previously indicated these highs as the top of the range. However, on the 6-month time frame, we can see that this $100.40 level is actually the range highs. Now, why do we call these the range highs? Simply because you can see we had a high posted here, an attempt to break that high, which failed. Here we had a low posted. We had then a move back above this range. And the next 6 months, we saw a reversal of that back into this range towards the lows of this range. Now what you can see here is we did penetrate these lows. However, we closed back above them. Then we had another test of these lows, which failed. And in the last 6 months here, we've had a push back up into the middle of this range. So let's break down to the 3-month time frame for a little bit more detail. Okay, so here we are on the 3-month time frame. We can see the range a little bit more clearly. Now what we'll do is we'll identify the equilibrium of this range by simply dragging a fib from the range high to the range lows. This is 91.92, and our 50% comes in around 96.16. All right, guys, so 96.16 is our level. This is our midpoint. We'll call it 15 here. So this gives us the higher time frame range that we are currently playing within. Another cool thing that you will notice is if we measure this move to the upside of the range and we clone it, drop it down to the bottom of the range, look at that. The measured move, the false breakout to the upside, was also very similar move to the downside. We saw a fake out to the downside and a movement back to within this range. And price is currently sitting within the equilibrium of this range that has held over the last 2 years. So let's drop down to the monthly time frame now. Now in the monthly time frame, we can see this in a little bit more detail. So there's been an obvious range in play here that we've highlighted with a deviation to the outside and a deviation to the downside. And price is currently stuck within the middle of the range. Since we do have a neutral to bearish fundamental outlook on the dollar, we are favoring a move back down into these range lows here at 92, and then potentially a move down into these lows at 88.25. Those will be the key levels into 2019. Is this low here at 92 and that secondary low coming in at 88.25. To the upside, we believe that this range high here at $100.40 will act as a ceiling for the dollar bulls. And if they can get above that level, the next potential resistance zone will be the previous range highs here at 103.80. We'll call it 103.80. That is what the technical aspect looks like at the moment. Now let's drop down even further into the weekly time frame, and now we can see in detail a little bit better what's happening here. Previously had a move down into this level, a consolidation, and a drive back above it. We're currently hanging around this equilibrium at the moment, with price having recently formed somewhat of a consolidation between the 96 and 97.70 level. Another thing to notice is that price is starting to form what seems to be a pennant pattern here. So if we connect these highs with these highs, what you'll see is that the dollar's starting to look a little top heavy around this 97 level here. And looking into the future, if we do see a potential breakdown below this level here, take out these stops, and then we can get a potential rally back into the equilibrium for a drive down into the 92 support zone and a potential drive further into the 88.25 level. Alternatively, what we can see here is a potential break of this pendulum, retest down here, and a drive up into the range highs. Get that drive up into these range highs here. What you can expect is to see some consolidation and rotations around this level, as we can see a potential bearish head and shoulders forming if we do get such price action, which would result in a move back down towards the range lows here at 92. Alternatively, if we do get this rotation here, a short pullback lower and a breakout, what you can expect is another dip and the buyers to push the dollar back up into these previous highs here around the 103.80 level, and from there on in we can see a potential move to around the 110 region up here. So that's what it looks like on a weekly basis. I hope that this helped, and I hope that this brings you a new perspective going into the new year with an understanding of the fundamentals and the key technical levels for the US dollar moving forward. I hope you enjoyed that. Good luck and good trading.